If you buy a stock in a business believing that you are part owner of that company, you behave differently from the stock market crowd. The vast majority of stock market investors believe that the stock exchange is like a big casino, and stocks are entry tickets to play the game. The buying and selling decisions of many investors are totally price myopic and have nothing to do with company fundamentals. They try to predict what the price of the stock will do in a short time and try to profit from that price swing. They think they are investors, but in reality, they are traders. They try to predict what the market will do during the short term and buy or sell their holdings depending on those market predictions. Predicting the market is impossible. History proves that predicting the stock market simply does not pay off. Still, traders spend tremendous amounts of time and energy trying to do just that. During the year's end, you can see market gurus and hedge fund managers try to predict the market for the next year. You can go and look back at their predictions for the previous years and find out what really happened, and you will find 90% of those predictions were wrong. The other 10% may be right, but that is because of pure luck, nothing else. Whenever those market pundits are very bullish on the market actually tanks. Whenever they are worried about the world coming to an end, the opposite happens. For example, just go to the market predictions made by many Wall Street market pundits during the end of 2008, after the financial crisis. You will find they predicted that 2009 would be a horrible year. The sky was going to fall, and everyone should get out of the market. What actually happened? The stock market started to rally starting in March of 2009. You cannot invest based on those predictions. Millions of market participants are taking action depending on their own perception of the market and what it will do. No one can predict what those millions of individuals think. Do you want to bet your hard-earned money trying to predict what others will do? In order to avoid this irresponsible behavior, you need to understand a company thoroughly before investing in it. If you want to become a better investor, you need to remove the trader mentality and think like a business owner. Thinking like a business owner before you buy into any business will have you eager to find out everything about the business. You'll research past revenue, profit margin, debt level, competitive forces, sustainability of the business model, market share, management performance, company capability, and so on. Before investing in a business, find out how that business performed in the last recession. Understand the history of the business and how it performed over the last 10 years. What is its earnings growth? What is its owner growth? Gathering as much information about the company before making any decisions is referred to as fundamental investing. Once you know all the facts about the company, you can reasonably assume the future cash generation of the company. You can also attempt to calculate the value of the company, which is called intrinsic value, a calculation that will be explained in a later chapter. If you buy the stock at less than the calculated intrinsic value of the company and hold that stock for the long term, you can do reasonably well in stocks. If you are a business owner, you do not sell your business as soon as you can get 10 to 20% more money for your business. Instead, you prefer to continue running your business and increasing its economic value over the long term so that you can earn maximum profit from your business. You need to have the same kind of mentality when you invest, even if you are merely purchasing 100 shares of a company.